So guys, obviously this year on the market has been less than stellar. I mean, sure, we saw a pretty nice and very brief pop earlier this week, which was a refreshing reprieve from all the red we saw before that, but it was very short-lived, and my gut tells me we're still looking at quite a bit of volatility moving forward. With that, emotions are definitely running high. Everyone's on edge, and this is when investing mistakes tend to happen. I've seen it before, and I've definitely made a few of these mistakes myself. So in this video, I want to walk you through 4 of the biggest mistakes investors make during a stock market crash, a correction, or any other turbulent time in the market, like what we're going through right now, and how you can avoid them. So guys, let's start with the big one, which is panic selling. This is one of the biggest mistakes that investors make, especially new investors, when the market starts to go down. And essentially the thought process behind it is investors thinking, I need to get out now before things drop even more, and then I can buy back in later when the dust has settled and everything's kind of bottomed out. And while I do understand that line of thinking, and while it sounds good in theory, it's a lot harder to actually pull off in reality. Because now you're stuck trying to make, 2 perfect decisions, when to get out and when to get back in, and most people don't get either one right. We have no idea what's going to happen on any given day. And I actually think that what we saw this week on the market was a perfect reminder of that. On Wednesday, midway through the day, the market was deep in the red. Then out of nowhere, it did a complete 180. And by the end of the day, the S&P was up over 9% just for the day. And then what happened, guys? Just one day later, going from Wednesday to Thursday, things were back in the red and the market was down even more. And it just goes to show how tricky trying to time things can be when every single day is different. And every single day, especially right now, we're met with just an insane amount of volatility where things are seeing pretty crazy swings in either direction. With that said, though, it is important to keep in mind that, just because stocks are going down, just because share prices are declining, that doesn't mean that your businesses are broken. The whole reason stocks are seeing such a crazy drop in the first place is because of the uncertainty caused by tariffs, not necessarily because your companies suddenly got worse overnight. And along with that, it's important to remember that the market will naturally have its ups and downs and its ebbs and flows, but historically it has gone up much more than it's gone down over time. And those who kept buying during downturns instead of selling, whether in 2008, 2020, or any other correction, were eventually rewarded for their patience. At the end of the day, guys, it's totally normal to feel anxiety when you see your portfolio taking a hit, but more often than not, you're better off not acting on that anxiety. Sometimes, believe it or not, the best thing you can do is nothing at all. Just go for a walk, maybe watch some Seinfeld, and whatever you do, do not make this next mistake. So guys, another mistake that I see all the time, and I'm definitely guilty of making this one myself, especially during periods where there's a lot of volatility and it seems like share prices are just freaking out. But the mistake is constantly checking your portfolio. And trust me, I get it. You want to know what's going on. And every time you go to check your portfolio, there's that little sense of what if in the back of your mind, like, maybe if I check it this time, things will have suddenly turned around. The thing is, though, the time it takes to do this throughout the day can really add up, trust me. I definitely feel that. It's easy to think that checking your portfolio is just this quick little thing, but by the time you've opened up Charles Schwab for the 10th time just to look at the numbers, you could have burned 10, 20, sometimes even 30 minutes without realizing it, and that time could be much better spent doing so many other things. And with that said, checking your portfolio value every 20 minutes is definitely not going to help you make better investment decisions. It's not going to make this volatility any easier to bear. In fact, it will probably just make things worse. The more you check your account, the more likely you are to take some sort of action, or at the very least, have a reaction to seeing your share prices continue to go down. And when you react out of emotion instead of from, a logical, rational, calm point of view, that's when mistakes start to happen. And in my case, guys, looking at my portfolio, I saw it go from being at about 93,000 at the start of April, at the very beginning of the month, to just a few days later dropping over $10,000 in value, settling under 83,000. And I would be lying if I said that it didn't sting just a little bit knowing that my portfolio has dropped that much. But I will tell you what, it would be so much worse if I was checking it 100 different times throughout the day, just hoping that the drop wasn't as bad as it actually was. And if we look at things from an individual stock level, it's even worse, guys. I mean, there are so many holdings that are just seeing some crazy drops. Starting here with Lowe's is the first one that's down double digits over the last month. But over half my portfolio, that's the case. AbbVie's down 22%. Starbucks is really not too far behind it. But at the end of the day, you have to keep in mind that stocks are not lottery tickets, okay? They're not just these things that randomly go up and down. These are living, breathing businesses. You're an owner of these businesses. And as an owner of these businesses, you have to have a long-term perspective. You have to focus on the long-term fundamentals and try as best as you can to ignore the short-term noise. And by the way, guys, what we were just looking at a moment ago was from Snowball Analytics, which is actually the sponsor of today's video. This is a really cool portfolio tracker that I think you guys would like a lot, and I want to tell you a little bit more about it. One of the most essential tools for any investor is a solid portfolio tracker, and Snowball Analytics is like the Swiss Army knife of portfolio trackers. I've been using this platform pretty religiously to track my own portfolio for a while now, and I'm extremely impressed by just how much insight it provides into my portfolio. As you can see, the layout is very clean and intuitive, and I found the platform pretty easy to navigate. Plus, it's packed with more charts and graphs than you can count, which speaks to just how much insight it offers, not only into your portfolio, but also at the individual stock level as well. I mean, pretty much anything you want to know about a company's financials or dividend history can be found here within Snowball Analytics. Now, in my opinion, what really sets Snowball Analytics apart are the features that it has designed specifically for dividend investors. I'm actually convinced this platform was made for us, and here are a few of my favorite features. First off, Snowball tells you your total returns by default throughout the platform, which may sound like a small thing, but it's crucial for dividend investors because it doesn't neglect the dividend income we receive when calculating returns. Most other portfolio trackers will only show share price returns, which is only half of the equation, so it's refreshing to see dividends factored into these calculations. Additionally, Snowball also has a pretty robust event calendar that keeps you updated with upcoming news, events, and dividend payments, and they even have a dedicated dividend calendar so you can see who's paying you each month, when they're paying, and how much they're paying. And then another favorite feature of mine is Snowball's backtest tool, which lets you see how your portfolio stacks up against the S&P or any other benchmark across multiple time periods. And once again, dividends are included in the calculations, which is awesome. And beyond these tools, Snowball also offers a community feature where you can check out other users' public portfolios to see what others are investing in, which is always a fun thing to look at. Plus, they have stats for stocks and ETFs that show what's trending and what's popular among other investors. This makes Snowball not just a killer portfolio tracker, but also a great place for dividend investors to get new investing ideas. So overall, if you're looking for a great portfolio tracker, which is something that every investor needs, then I highly recommend you check out Snowball Analytics, which you can actually do for free. All you need to do is click the link in the description of the video or in the pinned comment, or just scan this QR code right here to get a free 14-day trial. And if you like it, you can save 10% on your subscription when you use the code Ryne Williams. I've personally really enjoyed using Snowball Analytics, and I know you will too, so definitely check out that 14-day trial. And don't forget to use code Ryne Williams to save 10% on your subscription. Now guys, getting back to it, during a crash, it's easy to feel like a kid in a candy store. Everything's on sale. Everything is looking like a good buy. And for dividend investors, this is an especially exciting time because, as we've talked about many times here on the channel, when share prices go down, dividend yields start shooting up, and this is like a dream come true for us. But believe it or not, as easy as it is to swoop up everything in sight, this isn't the time to cast a wide net and just start loading up on any cheap stock that you see out there. Instead, I think this is the time to be especially picky. This is when you should really zoom in and hone in on what you think your highest conviction ideas are, the stocks that you've been waiting for and the ones that you've been wanting to buy the most. I think a good filter to use is to ask yourself this: would I still want to own this business if it wasn't so cheap? If the answer is no, then it's probably not a stock you should give priority to. And guys, on that note, I want to give you an example of this from my own portfolio. This is something that I've been struggling with ever since all of this craziness in the market started. Jumping over here to Snapstock, guys, I've been thinking a lot about Target lately. As we can see, it's really come down in share price. In the last month, it's down almost 20%. Year to date so far, it is down about 33%. It's lost a third of its value just in these last few months. And as we can see, the current share price is about $90 per share, which I think is the lowest that I've ever seen Target get. I remember a couple of years ago, I was kind of chewing on this stock at around $100 per share, maybe around $110 per share. And at that point, I thought it was cheap then, but seeing it now at $90 per share is just insane. And along with that, these valuation metrics couldn't be better. The PE ratio is almost in the single digits. The free cash flow yield is in the double digits, almost at 11%, which is just crazy. And with that, as the share prices come down, like we were talking about earlier, the dividend yield has just soared and it's almost touching 5%. So from every which way I look at it, Target just looks incredibly cheap, and that near 5% dividend yield is especially tempting. And also, Target's not a terrible business. But every time I have these thoughts about Target, I end up comparing it to something like Visa, which is a business I already own. This is my largest individual holding, and I would love to continue putting money into this company. And when I compare Target to Visa, it's not even close. And even though Visa is not nearly as cheap as Target, I think the fundamentals are so much stronger with this company. And overall, I think this is a much better business. And if I'm being honest with myself, the only reason that Target's even on my radar right now is because it has gotten so cheap and because the dividend yield has been pushed up so high. And there are other examples of stocks like Target that I'm thinking about this way, but I always come back to the idea that, like I said, I'm better off just putting more money into Visa, which for me is a much higher conviction idea, or putting more money, starting a position in something like Rollins, which their share price hasn't even budged, so I don't think I'll do that anytime soon, or even Zoetis, which right now isn't looking too terrible. The point is, though, you don't need to buy every single stock that's on sale with the limited funds that I think we all have. I mean, we always wish we had more money to invest, but with the limited funds that we have, I think we're much better off just focusing in on the stocks that we have the highest amount of conviction in. Those are the ones that I think you should prioritize. So guys, we always talk about buying the dip, and during times like this, being as aggressive as you possibly can with your contributions. And while I generally think that's a good way to go, that mindset can make you think that you need to put literally everything you have into the stock market all at once. And I just want to make one thing clear: that should not include your emergency fund. Like I said, I'm all for taking advantage of lower share prices for reasons we've already talked about. And if you've got extra cash sitting on the sidelines that you don't need for anything else, then by all means, put that stuff to work. But your emergency fund is not extra investable cash. That is there to protect you from real life stuff, like maybe, you lose your job, or maybe there's a medical emergency, or maybe, something's wrong with the car and you need to pay for that all of a sudden. The emergency fund is there to protect you from the things that you're least expecting. If you put that money into the market and something surprising happens, which usually does when you least expect it to, you might find yourself having to sell your investments at a loss just to cover that emergency expense. And that's not a position you want to be in, especially when share prices are getting lower by the day. Having said that, one of the worst things that you can do to your portfolio is to interrupt the compounding process. And so one of your greatest strengths as an investor is to not need the money that you have invested. And just to be transparent with you, I've got a good chunk of change sitting in a high yield savings account right now that's specifically earmarked for emergencies. And yeah, it's been killing me not to throw that money into my portfolio while prices have been low, but I have to remind myself constantly that that money serves a different purpose. It's not there for growth, it's there for protection. And if something unexpected were to occur, then I would definitely be glad that I had that money set aside. Having that is one of the things that really helps me sleep well at night. And on that note, another thing that helps me sleep well at night is not counting sheep, it's counting dividends. And in this next video right over here, I'm telling you exactly how much money I've made with dividend investing in these last few years that I've been doing it. I've been investing for about 5 years now, and in this video, I'll be breaking down the performance of my portfolio so far, along with all of the dividends that I've received up until this point. So click right over here to check that out, and I'll see you in the next one.